Welcome to the Ideal Investor Show. This is the podcast where we help you challenge your mindset and discover where you are. Tired of stories about other people's success? We can help you change your life, determine your time freedom point, and join us on the journey to financial success. Let's go. Hello and welcome to another episode of the Ideal Investor Show, where we bring you interesting guests and interesting people so that we can learn more and more things about financing and money and investing and how to actually achieve our goals. And today I want to welcome Flynn, or officially Kimberly Flynn, who actually founded XA Investments and has all kinds of like summa cum laude credentials and stuff like that. And we're going to talk a little bit about that. But first, welcome, Kim.
Thank you very much for having me.
Absolutely. I'm very excited, especially since we're going to be talking a little bit about alternative things. So I'm always interested in finding new and interesting alternatives. So that would be cool. But before we get to that, Kim, can you tell us a little bit what you're doing? How did you become the founder of a company like that? And what is your typical daily work looking like?
Sure. So I run a Chicago-based asset management platform. I've been in Chicago now for almost 25 years. I graduated from the University of Notre Dame and just ended up in Chicago like a lot of people. I worked in investment banking initially, and I've got a family, and that's not very conducive to having children. And so asset management and working in investments has been a terrific career. I love learning about new investment opportunities, and I've spent a lot of time building investments, building products for individual investors. You name the asset class or the strategy, and I've probably built a fund around it. I worked at Nuveen Investments for many years. Nuveen is very well known for municipal bonds. They also have a lot of other traditional investment capabilities. And so I had a lot of experience working with stocks, bonds, currencies, commodities, and that led me to founding an asset management business where we focus on things that are beyond stocks and bonds and more in the realm of private market investments.
That sounds a little bit like private market would invest in different stuff than regular people. Is that what you mean, or what do you mean when you say private market?
I do. I mean, the reality is that the scope or the span of alternative investments really encompasses a lot of different private market assets, including real estate. Real estate is really a gateway to a lot of the different types of private markets. You know, things like private equity, private credit, direct lending. These are all types of investments that you can't get access through the public equity market or the fixed income markets. And so with US companies staying private for longer, there's a lot of individual investors saying, well, how do I tap into the growth of the American economy? I have to access the private markets to participate early in some of the business building and formation that's happening while these companies are private and not yet listed on a stock exchange.
Yeah, that makes total sense. And I have a follow-up to that. I'm assuming then you must be kind of like jumping up and down after the recent Delaware decisions, right?
Yeah, I mean, I think that it's huge for the industry. And, in our part of the world, allowing individual investors to access a broader array of investments, the way endowments and pension funds, have long been investing, the responsibility for saving and for retirement is really on the shoulders of individuals. And so, we can't rely upon corporate pensions anymore, but we need the same tools to be able to generate the income and the returns. And so accessing private markets is really important for that equation. And like I said, real estate is one of the first places people go because they're comfortable. A lot of us own homes. And so the real estate investment experience is something that each of us knows something about.
Yeah, absolutely. And talked a little bit to the organizations that we get funding for our investments, not just for myself, but also for our clients. And especially since the mortgage interest markets and the more traditional, FHA or Fannie, Freddie and all that markets have gotten tricky, not so much because they are very different in the price, meaning like the interest or anything like that, but the way the lenders actually get their money has now been combined with more and more hurdles and requirements and qualification criteria, besides just the sheer volume going down, but in general to say, okay, I'm somebody like in my case, I'm a business owner with multiple properties and years of experience, tax returns, all kinds of stuff, relatively substantial income in comparison to a W-2 employee. And if I were to just go and say, okay, I want to add another property in the traditional finance market right now, I wouldn't say it's impossible, but the hurdles are just insane. I'd be interested in how you actually, for your organization, look at this, and lenders come in and say, let's focus, number one, on the asset itself and on the performance of the asset. When the asset and the performance is there, then we can do risk analysis and say, okay, how much are we willing to give for that asset with that performance, rather than saying Kim has to basically do some sort of a financial striptease until we find out if it's worth our time to give you a loan when you have a long history of being diligent and dependable in your payments, right? That's why you have a credit score and all that kind of stuff. So when you evaluate assets for your asset management, how would you compare that in with what the traditional markets do?
Well, I agree with you that the traditional markets have gotten tighter as banks have stopped lending. And not only have they stopped lending as freely to individuals, but also to medium and large size businesses. So even business owners who have, as you say, a long track record of success, they're having to look to alternative lenders. And the good news is that the private credit markets are going to be a source of supply, providing credit for businesses and for real estate investors in the years to come, because I don't think anyone expects that the banks are going to jump back in and loosen up their balance sheets and start lending again. So these alternative credit lenders, they're forming in a lot of the different parts of the investment market. So direct lending is just one example. Instead of issuing bank loans, U.S. companies are going to direct lenders and comparable, rates for those. And so if you take the financing side, the flip side of the financing for the business is the investment side. And so for a lot of retirees or people perhaps who are looking for an attractive current cash flow to supplement their living, investing in private credit, it's really the biggest part of our marketplace. Credit is so attractive right now. A lot of the funds are producing monthly or quarterly distributions, 10%, 12% annualized. So
Yeah.
very high yielding, attractive supplement to people's incomes, which is good for people who are trying to borrow, but there's also going to be a lot more demand for investors who are looking for these higher yielding income investments.
Yeah, absolutely. I totally agree with you. Now, real quick, can you just for our audience compare for just a minute the difference between the interest income that you just mentioned, if somebody gets 10, 12%, whether you call it hard money or whatever kind of other term you might associate it with it as a lender, so to speak, or providing funds for investments versus the actual capital gains, because I think it's important to realize if you get those interest incomes, it's not the same like
Yes.
if you sell a stock that you held for a couple of years.
Yes, you have to think about the composition of the return over time. And so a lot, I think part of the reason that people like real estate investments is that, there are some tax advantages of the gains. You're not just being paid ordinary income or taxed at the ordinary income rates. So I would say, depending on the strategy, the composition of return and whether or not it's tax advantaged in any way is very different. Some of the credit strategies, maybe they're lower yielding, maybe you're going to get 6 or 7%, which would be ordinary income taxed at ordinary rates, but then you have additional capital gain for another 4 or 5%. So, the nice thing is, even somebody who is very tax sensitive and is looking for a tax-free option, there's a couple of municipal funds. We always think about municipal bonds as being, ordinary or part of a lot of retirees' portfolios. But if you want something that's a little bit more aggressive, like a high yield municipal portfolio, what people don't realize about municipal bonds is that they're fairly illiquid, and liquidity risk actually implies that you earn additional return or additional premium. And so even for the tax-free investor that's looking for 100% tax-free sources of income, there's some really attractive, what I would call alternative municipal bond strategies. So the world of alternatives is opening up, really allows portfolio managers to invest more freely and to tap in sometimes to higher risk or less liquid investments, which generate attractive returns. And so it really does depend. You have to be very aware of what the tax implications, because if you're going to be investing in something that's 100% ordinary income, you're going to want that in a qualified account.
Yeah, absolutely. And I'm kind of curious, since you mentioned those municipal bonds or anything that is, let's say, local government. I'm not talking federal or not even state, but local government. Are you concerned that for locations that have high dependency on property taxes and stuff like that on the commercial side, that they're going to be suffering to an extent that they might be, I don't want to say defaulting, but they might have a hard time serving their bonds?
Oh, absolutely. I mean, you had that happen. Episodically. I think a lot of uh, local or state authorities were concerned in the 2020 period, but then the federal government kind of backstopped the local and the state level. So we always advise people take a diversified approach, even with municipal bonds. And so that would be investing in a national municipal bond strategy. There are some for people who live in the state of California. There are some really great diversified California only. So you get not just federal tax free, you get state tax free.
Absolutely. And thanks for describing that. I mean, what I was getting at, if I'm thinking, you mentioned Chicago, I'm thinking like places like New York that have a very large component in their overall mixture of commercial real estate. If those 700 or $800 billion of loans are actually really defaulting, then it's not so much the loans, because obviously the communities don't hold the loans. But then if the buildings are not used anymore or not occupied anymore and stuff, then obviously the taxes don't occur either anymore. And, I have no idea how much of a component. I just wanted to explain for the audience,
Yes.
a lot of very dense, very business oriented, larger cities issue lots of bonds. On the one hand, there has ever been a threat to that level in commercial real estate and especially office space and stuff like that, to the extent that we're facing probably in the next few years.
Well, and that's why, the federal government had to step in and backstop, cities like Chicago. And so surprisingly, Chicago's coffers have never been fuller, partly because of the funds provided by the federal government. But if that had not been there, I mean, occupancy rates in commercial real estate in Chicago are still in the 50%. My office is kind of an exception where everybody's in the office 5 days a week. That's very rare. So you're right. The federal funds at some point will run out, and we're still normalizing, right? We're not back to 100% occupancy. I think New York has done better than Chicago and some other Midwest cities. I think in certain places it's been harder to get people back. And so there's kind of a shifting of where do we tax, right? That's a whole nother conversation in terms of, so city of Chicago has also started looking at implementing a millionaire tax the way New York has done, to try to go after, people who are living in the city. So unfortunately, they'll go after and find different sources to make up for those shortfalls.
Yeah, that's why other New Yorkers go to Florida.
That's right.
Okay, now the other thing that I find so intriguing, I want to phrase it in a certain way, is how rich do I have to be if you were to ask you, hey, Kim, can you get me some shares for SpaceX?
SpaceX. That's a good question. How rich do you have to be? The nice thing about for investors looking for access to private companies or private equity, that minimum dollar amount has really shifted. So you had to be a small institution or a family office to get access to some of the best private equity, partly because it's the retail market, it's the individual investor who's saving for retirement. That's the part of the market that's growing. The institutional part of the market is continuing to shrink shrink because we no longer as a society have pensions. And so with that growth, you have, some of the world's leading alternative investment firms like Blackstone or KKR or Apollo. They're all launching products for retail investors. And so for a minimum investment of $5,000, $10,000, you can have a fractional share of one of these, and they're registered funds. The type of fund is called an interval fund, and it's really opened up access for the average investor. Without many of the funds do not have any suitability restrictions at all. Some of the private equity strategies are limited to higher suitability, maybe an accredited investor, but it really opens up the playing field for the average investor to express their investment views. If they do want SpaceX, they want venture capital, they can do so in these new products.
Thanks for explaining that, because I think that's really important. This whole cloud, in a sense of you have to be accredited and then go through the criteria of what that means before you can kind of like play. I mean, I'm also thinking SpaceX is probably pretty advanced already. I mean, like I said, when we started, like the Delaware decision has probably told Elon, I'm not going to take an IPO anytime soon, right? Or maybe even with Starlink, for a while he would separate Starlink and SpaceX from each other and then launch Starlink as an IPO. But I think what comes, at least when I read the tea leaves to the extent that I believe I'm able to, I would say anybody who is currently having a successful and thriving and growing private company, not IPO, is probably thinking twice if they want to expose themselves to the public market based on what is currently going on. Kind of nice that then people like you are out there that can help us, and especially if, like you just said, it's no longer, you have to be already like a Ron Barron or something like that to get in the door, right? So the other part why I wanted to ask the question, and I think like things like Neuralink could be like super interesting, right? If you think about it, they just did their first human patient, supposedly doing well. If that actually works, think what kind of a company that would be if you could heal, like at least to the point that they can participate as in the society, like quadriplegics and blind people and deaf people and all that, right? Like to me, that sounds interesting. And from a business perspective.
I agree. I think that's what people are looking for, the opportunity to invest along, the next SpaceX, and what is that going to be in the coming years? And so there's a lot of talk around, unicorns, which are these large companies, but they're still private. And, if they're choosing for a lot of reasons to not go public, you need to be able to have an earlier entry point. So I think that's what the regulators have realized, is that individual investors are missing out, and why we prohibit people from being in a diversified way. You want to work, particularly with venture capital or private equity, you want to work with firms who know how to diligence and evaluate these companies, because for every SpaceX, there's probably 10 companies that fail. And so you want someone who understands how to pick the best next sort of what's on the horizon, what's coming next. And so now investors have that opportunity where they didn't 5 years ago.
Yeah, absolutely. So I think these alternatives are also an opportunity to say we can reset or level set the trust that is needed, right? Because when you trust your money with somebody, and I always say this to anybody who comes to us, I'm sure you do the same, to say it's all a matter of a trusting relationship first. And then we look at what we actually really do and what we can get comfortable with and explain and learn and execute together. That private place, that private alternative place, whether it's stocks or creative funds or municipal bonds and stuff, I think is a really an opportunity to say, okay, there are other alternatives that don't have that stigma that the industry
Right.
has given itself, like.
I think a lot of financial advisors, everyone was disappointed with 2022. Neither stocks nor bonds worked. And so it really opened up the conversation that financial advisors were having with their clients about, maybe, what we find is that US investors are over allocated to large cap US public companies, right? And they should be diversified into things like real estate, municipal bonds, other types of investments. But and advisors, I think, are also, they tend to have that bias as well, right? That we over allocate to one part of the market, which was working so well for so long. And then 2022 comes around, and now we have to rethink the model. We have to rethink how we're giving advice. And so we don't want clients to be disappointed. And one of the benefits that people talk about introducing a private market investment, like a private credit strategy or a private equity strategy, is that it's going to move potentially in a different direction than the public equity market. And that's what you want to reduce risk, to reduce the downside. Having both of these, public and private, in your portfolio at the same time. And if you're adding things like farmland or real estate, all the better, because then, when farmland is performing in 2022, 2023 because of inflation concerns, that's going to offset some of the negative performance from commercial real estate in 2022. So that's what we like to see, is over time, you're generating a high level of returns with less risk, but what's driving the return shouldn't be 100% US large cap equity, which for a lot of financial advisors, I think they had their clients in portfolios that were over allocated. And so when you have one source of return and one source of risk, you get more volatility, and that's a rougher ride for clients.
Absolutely. I also find it a little bit disingenuous that when it comes to the investments, to actually do what you just described, Kim. But when initially the description comes, okay, what do you do with my money? It's always being argued from the large perspective, right? Then you hear people say, well, historically, the S&P 500 did X, like 7, 8, 10, whatever percent return, right? And then I actually sometimes make fun of these guys. So how many of the 500 actually did those returns? Right. And especially the
Right.
last 2 years, if you take the Magnificent Seven out, then it's a horror show,
It is.
So, but no, I'm glad that there are these alternatives that you are offering. I also want to, for our audience, and I want to ask you really quick to tell me if I'm wrong about this, but I believe there is a completely undue pressure on public companies and similar equities with this insane quarterly performance report requirement. I mean, if I look at where that was 20, 30 years ago when I first started, like 35 years ago is when I first started looking into investing. And the quarterly reports were more like a formality that you submitted to the SEC. And that whole kind of theater play that is now happening, especially for the bigger companies every 90 days, this whole community of analysts that is basically pretending that they have a crystal ball to predict basically what the future holds and how the companies should match up to that. In real estate, we really don't have that. But I also think in a company like we said, SpaceX or Neuralink or any other privately held company, just not having that pressure to do everything to satisfy some community of people who don't even really know your business every 90 days, I think is a huge difference. Do you agree?
I do. And I think the reason for it is that people, in the name of transparency, they've produced this pressure cooker, if you will. But the result of it, in my opinion, is a very short-term focus, right? The quarterly earnings grind, you're only focused on the next quarter's results. So how do public companies make medium to long-term investments? So it's at odds with growing the business. And so I think that's why these private companies, to avoid the pressure of that quarterly reporting cycle, they are able to grow the business for the next 10 years, as opposed to the 2 quarters or the next 3 quarters. So it is a challenge. Public companies, the rigor of it and the increased transparency. So, I think the SEC always talks about transparency being better for investors, but these are some of the unintended consequences of pushing for that sort of disclosure. And I agree, like I don't, particularly for some of the largest companies, research analysts, do they have a lot of, edge to their research? Probably not, because everything's being reported fully. And so as investors, though, I think that gives us potentially you see it with a lot of people who are very enthusiastic about small to mid cap companies for the same reason, where there's actually an opportunity to analyze and evaluate a company and maybe find something, develop an edge that you wouldn't if it was one of the FANG stocks. So I do think that investors have to be thoughtful and have a competitive advantage when making investment decisions. And if you don't, then it is probably better just to take a passive approach.
Totally with you on that. There is no way that anybody can convince me that a 90-day cycle has anything to do with investing.
Yes, I think you're right about high frequency trading and the impact that it's had on markets. And frankly, it does. I think there's a lot of individual investors who have been harmed, because it produces a lot of volatility. But and that's why I always say people will ask me, friends, family will ask me for individual stock tips, and I'm like, I'm not a technical trader. That's not what I do. I advise companies and asset managers on how to build product that's going to endure, that's going to over a market cycle is going to benefit investors. And I'm particularly, just as an individual, I'm not particularly interested in things that like Bitcoin, where I don't understand the fundamental drivers of the market moves. And so I'm with you personally. I like understanding, the assets and liabilities, for example, of like a real estate rental. I can understand that. I can do the math on that. But some of these other things, more technical trading, you're right. It's anybody's guess as to if it's going to go up or down.
Absolutely. And see, I think you said something very, very profound just now, Kim, and I'm very much with you on that. For me, there are two ways to approach investing, regardless of the assets. The one is that you, outside of the financial side, became or gained expertise in something, and then have a better foundation or a good foundation to say, because I have this expertise, I can also pick and choose my investments in that same space. And I'm going to give an example in a moment. And the other group is people who say, I'm fascinated by a certain asset class and I'm willing to learn what I need to learn to gain a similar status like somebody who has the expertise. So with my own example, for 22 years, I was in aviation. I flew fighter jets. I was a test pilot and stuff like that. So it's not a super far jump to say I'm not only fascinated by SpaceX, but I also get a little bit more than maybe the average person who just sees the rocket going off the ground. What is actually going on there? What makes sense? What doesn't make sense? Why is high iteration better than NASA approach, and why it's so much cheaper, and those kind of things? Or like when people come to us and say, okay, we want to have a passive income portfolio in real estate, and we are willing to learn from you, since you have already done it for 15 years, how you did it and what you learned, so we can do it faster than you did. Those are, I think, the two categories. And most of what we discussed about this public market leaves that typically out and says, you go to somebody who claims to be an expert, just give him your money. And I think the most egregious thing in that game is actually 401k, where you don't even know the person. You only know that somebody in your company has make an agreement with the Fidelities or the Vanguards of the world, and they're just taking some money out of your paycheck every.
Yeah.
And
Yeah.
I have done this. It's almost a game for me by now to say, hey, where's the money of your 401k actually invested? Nobody has a clue.
I think that it's a lot of one size fits all portfolios, and it's all traditional investment exposure. And so I do think a lot of investors are ultimately disappointed by their 401k performance, because a lot of them are allocated to target date. I suppose for the smallest investors who don't have the wherewithal, it's better than not saving. But I do agree that if you can do a self-directed IRA and allocate to some of the stocks where you have a passion or you have an interest and you're following it closely, it's really that active engagement that's so important in terms of making these informed decisions. And always, even for people who have background in aviation, I always encourage a diversified approach, because you never know. And if you're the one in charge of your investment future, I think the apprenticeship sort of model that you advocate, learning from people who've had that experience, is very wise, right? It takes a while to get good at investing. It takes a while to get good at real estate finance. And so I think what you're spreading is the right message in terms of how we should approach it. But it is our responsibility. And I think education is so important, and trying to find the better partners or better advice models is really encouraged.
I'm always big time telling everybody we need to diversify. The weighing might be different based on preference and risk portfolio and of profile, but diversification is obviously important. I'm not preaching that anybody should be 100% in SpaceX or real estate or anything.
Yes.
And that comes back to you. And if somebody wants to get some advice on how to do these alternative things that we touched a little bit on, how can they get in touch with you?
Sure. xainvestments.com is our website. We've got a lot of white papers and literature in our knowledge bank. We do spend a lot of time educating people on alternative investments and some of the benefits. So please go to xainvestments.com and you can find my contact information there.
And is there any kind of minimum amount that somebody should be aware or willing to put down so it makes sense?
I think most of the investment minimums on the funds are as low as $2,500. And so,
really?
yeah. And so I think what we advise is that, if it's not a 5% allocation in your portfolio or greater, then it's not going to be worthwhile for your time to research the investment or to follow the investment. So, yeah, there are a lot of alternative asset managers, like I mentioned, some of the market leaders. They all have products. There also are some direct to consumer platforms, like Fundrise is a real estate direct to consumer platform. And so there are a number of sort of fintech platforms that make it easier for people to do it directly, to do it for themselves, as opposed to going to a financial advisor.
I'm really glad that we had you on the show today, because I agree there's the Fundrise things that some have $100, some have $1,000, and others $2,500. But I think there is this space before you go to the typical accredited or like syndications with 50,000, 80,000 minimums and stuff like that. There is kind of like a place in between there where it is a big enough amount of money that it makes sense to have help, but not such a huge amount of money that, or a requirement that you need to be accredited and all those kind of things. So that's really good. And thank you for helping us understand what you do and how you do it and so forth. So with all that being said, I have two more questions for you that are not really related to finance. The first one is, Kim, if you could meet anybody dead or alive, who would it be and why?
I'd probably pick Queen Elizabeth. She's behind, actually, that's the Queen of Denmark, and then the Queen Elizabeth's on top of her. But she was actually the same age as my grandmother, who passed away in her 70s. But just fascinated by a world leader who lived through multiple generations, and obviously wasn't, in certain times, wasn't very popular. But we did some work in London for our business and got to go visit Windsor Castle just a month before she passed away. So
I have to follow up with, did you see the series about the Queen?
The Crown, yes. I actually thought it was based on a biography. It was authorized by her, and so I think it was true to the experience of monarchies. I enjoyed it.
Yeah, me too. Yeah, I'm with you. I enjoyed it too. I'm not into the monarchy stuff. Just stumbled into it, I guess, on the plane ride or something like that, and then came home and watched all the other episodes. So,
it's very well done.
Yes, exactly. Final question is, if you had a time machine, you can go forward, backwards. Where would you go and why?
I would go 50 years in the future, and spy on my children. But no, see kind of what the world looks like. As a student of history, we know a lot about the past, so I'm kind of more interested in what we don't know, and maybe we will be in space 50 years in the future. But
yeah, I was just about to say, is there a city on Mars? You got to find out and tell us.
Yes, hopefully we still have a healthy planet and whatnot. But yeah, it'd be interesting to see what the U.S. looks like in 50 years.
Yeah, I'm with you. Cool. Well, Kim, thank you so much for being on the show, and the Queen and 50 years in the future. We will check in with you and see how that came out.
Great. Thank you so much for having me. I appreciate it.